Well, hello everyone and welcome. Thank you so much for joining us today. We are here with Martin Hofgotcom of Janus Trading for our webinar, Politics, Central Banks, and Elections Weathering the Perfect Forex Storm. We'll turn you over to Martin and Shireen in just a moment, but we have a little bit of housekeeping to do. Audio will be listen only. I hope you can hear us. You do not need a microphone. If you'd like to ask a question, and we do welcome them, please use the GoToWebinar toolbar. It's probably on the right side over there. Ask anytime. We'll answer a few as we go along and catch up with as many as we can by the end. Please remember the blue box here. The topics discussed in today's webinar are intended for informational purposes only and are not intended to be investment advice, recommendation, or opinion by Currensee. Additionally, any opinions or recommendations expressed by the panelists and guests are solely those of the panelists and guests and not necessarily those of Currensee. In addition, please note the risk warning. Over-the-counter retail foreign currency trading, that's Forex trading, may involve significant risk of loss. It is not suitable for all investors, and you should make sure you understand the risks involved before trading and seek independent advice if necessary. Additionally, we have some notes about the Trade Leaders Investment Program that we'll talk about later in the presentation. So now it's time for the webinar that you signed up for. I'm going to turn things over to Shireen Shermack now.
Greetings, everyone. Let's talk about our agenda today for a moment before we get started. Today we're going to talk through some introductions. I'll mention who I am, which is Shireen Shermack, and I am the Director of Trade Leader Management at Currensee. But we'll talk a little bit more about Martin and Janus Trading. Then let's talk politics and banking with Martin Hofgotcom of Janus Trading. We'll go through a little bit of information about Currensee and our program, and then we'll take your Q&A. Let's talk a little bit about Janus and our guest, Martin. Janus Trading is a private German company founded by 5 traders and programmers with diverse areas of expertise. It's based in Bingen on Rhine and Reda-Wiedenbrück. I hope I got that right, Martin, near Frankfurt. Maybe I should have stuck with near Frankfurt. Martin Hofgotcom is the managing director of Janus Trading. He's a professional trader and a system developer. In the approval process for the German Public Fund Manager license, which is quite a prestigious and hard-earned license in Germany for managing funds. And he is also the manager of Currensee Trade Leader accounts JASMI-A and JASMI-I. This is a little snapshot of the growth of 10K in those 2 strategies over time since the 1st of April 2010, around when our program first started trading and when the accounts began. As you can see, fairly consistent strategies up and to the right, which is what we always look for. Also note that past performance is no indication of future results. So let's get right into it and talk about the world and a little bit more about Janus and their trading philosophy. So Martin, if you would, can you tell us a little bit more about the background of Janus and your key philosophy in trading?
Yeah, first of all, greetings to the audience and to all attendees, and thank you for giving the opportunity to tell a little bit about Janus and our trading itself. Janus was in the first place several years ago founded and created to trade our own funds because we have 5 people in the company, as we mentioned, with different areas of expertise, but all have substantial amount of funds in our trading operation, and that was the first idea. After we had become quite successful in doing what we're doing still today, we got approached by several investor groups and also by one brokerage firm in the United States whether we would be interested to also trade investor funds, which was never our first intention. But as we grew, we took on more clients, and we're offering the Currensee program, and we're also offering for larger investors, obviously, and money managers, still the trading in our operations, but that is unrelated to Currensee's efforts to also help us as one of the trade leaders. The basic idea and the key philosophy is that we're saying that we apply a portfolio of different trading strategies, up to 10, which work in different markets, obviously better or worse, depending on what type of strategy that is. And in order to then create a steady and substantial gain in the accounts and the portfolio, which is having a little or not so much that trading different strategies as a portfolio presents the lowest risk available, especially in markets as we have them since probably the year 2007, 2008 in the Forex world.
Okay, thanks for that. So I know you have strong feelings about how much volatility is enough and how much is too much, both in the market and in terms of the strategy's exposure. Can you tell us a little bit about that, since your strategy and approach is so grounded in it?
Well, first of all, we have to differentiate between volatility and volatility. Okay, what we are seeing, especially in the last several days here after the New Year break, what we are saying is not really volatility in its every, let's say, hour or 2 hours. Okay, so volatility itself is always so volatility is fine, but now the question comes from what source or what is causing that volatility, and that will be a topic, I think, in the next couple of minutes here as well, that besides traders and besides people participating in the market for various reasons, we have some other players which step to the plate, I would say, after the Lehman Brothers crisis in 2008, which are causing that volatility intentionally or unintentionally, but no matter what, we have to live with that market, and we can live with that market, but it's probably not the easiest type of market, because there might be totally different goals and totally different intentions for various players participating in these markets nowadays, since they were probably a couple of years ago.
Okay. Yes, the last week has certainly been a challenging one for traders, the last actually couple of months, responding to what's going on in the markets. So how has your strategy been managing in this environment of volatility the last couple of months?
I would classify it as fair, so we didn't lose a whole lot, but we didn't make a whole lot, which basically is exactly what was expected from that type of portfolio, because what you want is that in times where everybody is performing well, that you are also performing very well, so outperforming, but in times where everybody is having a difficult time or is losing, that you are losing only very little. So protecting the investor money, protecting the own money is very important during these times. And on the other side, when the markets are getting into a different phase again, then obviously you want to participate on the upside much more than you have lost on the downside. Unfortunately, that is not possible if you're using only one particular strategy. Let's assume we're talking about a breakout strategy. That breakout strategy might have worked well a couple of times, but probably in today's or last week's or the couple of weeks ago markets, you would have encountered very hard times, because the markets were just not really breaking out. There were some sort of stair-stepping down or stair-stepping up, which is very difficult if you're trading such a strategy. On the other side, last week probably was very good for range-bound systems or range trading itself, because we were in a, let's say, 150, 200 pip not much. So you have always different markets which prefer certain strategies, and what you don't want to do in rough times, you don't want to bet or set everything on one strategy and then find out that this exactly was the wrong strategy. And also what happens during these times, many people tend to have a predefined opinion where a particular market or a particular currency or a particular commodity or a stock market index will go. Like some people you will hear, oh well, at 128.30 the euro US is still way too high. It should belong to 1.10. This is very nice. It's a very bold statement, but could be or could not be. So please, if you encountering such times like we have right now, just trade what the market is showing you and don't have your own opinion in your back of your mind telling you something different than probably what the systems or what your shorter term strategies are telling you. So you have to be open-minded that you have to trade the market and not what you think the market will go to.
Okay, that sounds like really good advice. So, we talked a little bit about win ratios, and winning when everyone else is winning. We had an interesting chat the other day about, there are some strategies out there that claim to win 95% of the time, and I, of course, see them all the time, but they're holding on to their losers until forever. So, your core belief centers on slow, steady gains. Why would an account with a 95% win ratio be risky?
Yeah, well, because it's not only the win ratio which makes a good system, a good strategy, or even a good trader. It depends what really is the risk-reward ratio. So that means in terms of risk and in terms of gains, that has to be somewhat balanced. Obviously, it's pretty easy if you're saying I want to gain in Forex 10 pips and I'm working with a 250 pip stop loss, that obviously I probably have a very high win rate, could be as high as 95%. But one of these days it will happen that you have 2 or even 3 stop loss hits in a row, and then obviously you will figure out that you just lost the profit of your last 6 months, your last 9 months and all that, and such systems are very risky to trade. But they give investors, as long as everything runs well, a very nice safe feeling, because they see a win here, and a win here. But always remember the old German saying, what we had already on the floor at the stock market, saying small gain, small gain, small gain, small gain, huge loss. Okay, this is usually how this goes, and so investors need to look for more than just the win ratio or the win rate of a particular strategy or system. We have a total different belief here, because we do believe that a stop loss has to be on every trade, because you need to know in advance what you're going to risk and what you're going to lose. On the other side, you need to have also a pretty clear idea what you're trying to win. So meaning, what is the ratio between the stop loss and the take profit? And that has to be somewhat in order of magnitude 1 to 1 or 1 to 2, but never at 1 to 10 or 1 to 20 or something like that, where you're basically following such a strategy. Trading without a stop loss, what some people prefer to do, because they're saying I have a mental stop loss or something like that, is in markets like that detrimental. Because you will probably then revert to what I said before. You have a particular opinion, and then you will stick to that opinion, and then you will add to the position, and you're adding to a losing position, which are all typical investor behaviors, which a lot of people tend to do, who are doing this with own money, but only for fun. But professional traders usually don't do that, because they know that taking a loss is much better than holding on to a losing trade, not accepting a loss. So this is our core strategy here, that we're saying even if we have 10 or 15 losses in a row, that doesn't make the strategy bad. The question is, how much are you going to gain if you have 10 or 15 winners in a row, which is also quite often happening. But from an investor standpoint, we do understand that an investor feels very uncomfortable if he sees 5, 6, 7 losses in a row, and he might even think, hey, this trader has no idea what he's doing. But be certain, somebody who's professionally trading and he's doing 5 or 6 losses in a row, he knows very well what he's doing, and he should be pleased that you have someone who's doing it like that, instead of somebody who's opening 5 or 6 positions without a stop loss, letting it go 100, 200 points, and then it's getting a hope and pray strategy, which is absolutely detrimental in such markets where we have the strong reversals and then probably strong trending periods, like you saw from the Euro-US coming from 140 down to 126 within probably 2 months, 2.5 months. If you're betting on a, let's say, increasing dollar at 140, and then you're starting buying all these positions low, and then all of a sudden you find yourself in a very, very dangerous situation with your money. Okay, and this is what it is important to avoid with very disciplined and very clear and very straightforward strategies with clear goals, what you want to risk and what you want to gain.
Well, that couldn't be a more timely comment given the markets the last 24 hours. Okay, so central bank intervention. You know, central banks appear to be taking a bigger stance in supporting their currencies. We've seen this in Japan and other countries in the last couple of years. How have these support levels impacted Forex trading?
Well, first of all, we all know that Bank of Japan, even with letting investor world know, is stepping from time to time into the currency markets and is intervening. Okay. On 6th September last year, we had the Swiss National Bank for the first time stepping up to the plate and saying, well, the Swiss franc is too high, so basically what we want to do is we want to floor it at 120 towards the euro. This is open agenda. But obviously there are some hidden agendas, and when we talk about central banks intervention, we also need to talk about a little bit, which is probably the next slide, about the politicians and the politics having their agenda too, because that goes usually hand in hand. Okay, so what we have noted over the past, let's say 2-3 years now, that more and more the politicians are driving the markets. Why is that important? Because what we all know or should know is that there are news announcements probably in every single instrument, currency or whatever, all around the day. Each day there is an announcement, usually at predefined times. It's repeating every month, so everybody can basically adjust the trading around those news releases. Problem is that politicians tend to do not really obey or observe these times. Okay, so they're not going to say, well, we have a meeting between Mr. Sarkozy and Mrs. Merkel, and that finishes at 11 o'clock at night, and at 11:05 there will be a statement so that everybody can basically prepare himself or herself that there could be some increased volatility. Not only that we have seen that these announcements and also interventions are coming at odd times, meaning, for example, after the markets have closed in the States, and the markets are usually closed around the world then, so what we call the gap session, there have been announcements which have brought volatility during these times, which we have never seen before. Also, from time to time, we have announcements on weekends, which then lead to huge gaps or to very surprised markets on Monday mornings, and that has to be all figured in. So central banks certainly have agendas, and I would like to just go a little further and say what is good and what is bad as we see it from the Janus perspective. Right now what we're seeing is that the economy in the Euro land or in the Eurozone is struggling. On the other side, the Eurozone, especially Germany, is well known for their exports. So in order to basically support economic growth, the European Central Bank has just no other possibility, because interest rates are already very low, than basically saying, well, a weak euro is pretty good for our exports because it makes goods all around the world, especially in non-euro countries, affordable, or more affordable as it was before. So everybody thinks, okay, with a weak euro, we're getting more goods to order from, let's say, countries not having the euro, and that will fuel then finally the economic growth in the Eurozone, especially in Germany and France, where the big exporters are sitting. On the other side, the US dollar, strong, is not so bad because it's good for imports, because obviously European cars are getting cheaper, Shireen, so you can look at this nice European cars here. And on the other side, for the markets, especially for the stock markets, even if they are, let's say, plus minus zero or just slightly up or slightly down, an increase in currency always gives an additional, let's say, benefit for foreign investors, because they could even argue and say, well, I have gained in the currency even though I have not really made a lot in the stock market or in the bond market. I have basically a 10% currency gain or something like that, which is also nice to bring back home. On the other side, it makes for let's say the people happy, because they can travel abroad and not spend so much US dollars when they travel to, let's say, locations like Switzerland or Germany. It's getting cheaper for them to come over and take a trip abroad, for example, which makes the people itself happier. Okay, so for the Germans right now it's not so good, because now going to the States for us is more expensive as it was probably a year ago, okay, or even 2 years ago when we were having the highs in the euro. So this is something where the people really have or is a direct outcome of where do politicians like or want to have certain currencies. And since they don't do it by themselves, or they don't do it by announcements, they're using the central banks basically to do that. So keep in mind for the trading, keep in mind announcements might come on a hidden agenda, so nobody is really disclosing, besides the Bank of Japan, what they want to do. And the Swiss have also dropped basically the word that said we want to have at 120, maybe they go higher at 125, but usually expect interventions from central banks at odd times where the market is thin, and expect when we have meetings on the euro or other stuff, then expect that there might be odd times where announcements come out, so meaning during times where you don't expect them, so don't be surprised, which means you need to follow the actual news string via appropriate means much closer than you probably had to do it by just looking at the calendar and saying, well, this is not such a big deal because we're having here predefined dates and predefined times where we can easily see what's going on and what we have to expect, okay? So this is to keep in mind for central banks and politics.
Okay. While we're stop for a second, I want to remind people that you can use the question and answer tool on your GoToWebinar dashboard on the right of your screen to ask questions. We've already gotten a couple of good ones already. So any questions that come up, please type them in, and we'll take them at the end, or maybe even sprinkle them in if they speak to the subject matter. So speaking of...
Shireen, sorry, if the questions are directly related to what we just had or we're talking about, then obviously I'm willing to take a question which is related to what we have. It doesn't matter, because otherwise we need to jump back.
Okay, well, speaking of that, I just got a question that said, would you say then that one could expect a continued environment of volatility and expect news releases to be done off market? That comes from Mark.
Yes, absolutely. Because we will have lots of surprises still to come, and for all these surprises, obviously the appropriate people have to react. So it means they have to talk, they have to probably do a conference on a weekend or an emergency conference late at night or whatsoever. So be prepared that the, let's say, the agenda as it was before, where you could look it up in the calendar and you knew exactly what's happening, that this agenda will be will not be the current agenda. So be prepared that we will have continued crisis and solving an announcement of such in the, let's say, probably next 1, 2, or even 3 years, until the crises all over the world are somewhat under control.
So Hugh asks additionally, why would banks do the announcements on the weekends knowing that they would bring chaos on Monday?
That's a good question. Okay, actually, they're not doing really the announcements on the weekends. But look, for example, let's take an excursus here for our friends in Standard & Poor's. Okay, so isn't it a coincidence that they did it on a Friday, where the whole week or the whole world was already preparing for a long weekend in the States at least? And isn't it funny that on Monday there was a big offering on the EZB umbrella, basically, where they were raising whatever 1.5 billion euros for that umbrella. So I'm not a big believer of oh, it's totally unrelated. So everybody has an agenda, and everybody has to really expect that it's coming to a bad time. So it's always the wrong time when they make those announcements, and politicians are basically saying we want to calm down the markets. What they're actually doing is exactly the opposite. They're not calming down the markets, they're creating panic in the markets, because everybody is basically wrong-footed if you have such an announcement, and then a market which was sailing nice and up and going into a holiday mood was basically then taken in apart. Okay. In the Euro US within half an hour.
Okay. Let's talk a little bit about political events. So how could the elections in the next year in the U.S. or even the selection of a Republican candidate impact USD pairs? Will this add to volatility in the next year?
Well, this will certainly add volatility because, as I said, the agendas could be different. Okay, so we all know the history of U.S. elections, and whether one candidate or the other is more favorable to become the next president. There are even lots of statistics about the stock market, how it behaves 1 year before, how it behaves in election year. I'm not a big believer of all this because of no statistical really values here. But what I do believe is that we will see a lot of volatility, especially in the Euro USD cross here, and also the other USD pairs, which are at certain critical points right now. If you look at the USD yen, for example, and you look at the USD Swiss, there could be something coming up within the next, let's say, 12 months or so, for totally different reasons. Okay, so which could be contrary. So one side on that pair could say, well, we want to have it weak, and the other party could say, no, we have a totally different agenda, we want it the opposite way. So that needs to be kept in mind. Okay, so it's not good or bad, it's just don't forget about it.
Okay. Okay, another question, another doozy. And the euro, will the euro break up? Does it matter?
Well, eventually the euro has to break up because or not really break up in the real break-up sense, but certain, well, let's put it that way, Euroland will lose certain countries along the road. Okay, so Greece might be the first one, but there might be others, and certainly others will be very eager to join the euro, but it will not really break up as a whole currency, because that would also question the European Union and the spirit of united European countries and all that. So the political question is not really will the euro break up. The question is, will we lose certain euro partners or countries which are right now in that euro land? Will we lose those? And the answer is yes, we will probably lose certain candidates here. And what effect will that have? Most likely it will be positive or perceived positive for the euro, which a lot of people believe that anyway versus the US dollar it should be much higher, but due to inherent problems in Euroland, it's probably right now the question between two ugly faces. Okay, so it's like two ugly girls dancing. You have to drink a lot of alcohol to ask one. Okay, so it's the same here, I suppose.
All right. I have let's move on to the next piece. I've asked a lot of the trade leaders in the last week about the breakup of the euro, and it's interesting because people have a very similar take, but everybody has a different reason for it. Let's move on a little bit to your participation in the program, your trade leadership. You've been in the program a long time. Tell us about how your philosophy works well in the context of money management in the Trade Leaders Program.
Well, first of all, I think that the idea of that Trade Leader Program is quite a good one, because the investor has a choice of different risk levels, different offerings here, and can really split the funds among several trade leaders, which as I mentioned before, we are having some sort of portfolio idea here. So splitting funds among several traders is nothing else but using different strategies in one portfolio. So, which is quite a smart idea and probably quite a good idea, because you can also analyze where the strengths and weaknesses probably of every trader and trade leader is. In general terms, we are very happy with the program, and we try to provide a low risk or very low risk profile, which obviously has the disadvantage that it takes well over the minimum to basically participate and get the risk profile as we trade it, because we're trading quite large accounts in or as the master accounts for the trade leader program, which makes it sometimes difficult for individual investors to catch all the trades or follow the trading in its full extent. But probably, Shireen, you have some
news on that front.
Comments on that one, yeah, and news on that one, yeah.
Yes, I'll talk about that in a moment. Okay, well, let's give Martin a break. We'll come back for some questions and answers, but a word from our sponsor. I work for Currensee. I recruit all of our trade leaders and work with leaders like Martin all the time. There's a very diverse group of them. Currensee is all about diversification. Diversification of your portfolio to include Forex, which is where we really feel like we've made that possible for many, and diversification of your Forex portfolio to include different trading strategies. Let's talk a minute about what Currensee can do for you, and then we'll do some more questions. So we're headquartered here in freezing cold Boston, Massachusetts. We have about a 30-person team with experts with backgrounds in everything from financial services and social media to, of course, deep backgrounds in software development. We're a member of both the NFA and the FSA, so we are regulated. And I want to thank everyone for joining us. Again, if you go to your GoToWebinar Q&A tool, we'll answer as many questions as we can. And to learn more about investing or allocating, there are a few website addresses there. If you just go to our website at www.currensee.com, you can see the information on how to get into the program, and you'll also see a leaderboard with Janus on it. One of the comments I wanted to make, you're going to get a copy of Janus's trade leader data in your email box soon. And the recording will be posted, the recording of this webinar will be posted next week. In addition, I wanted to mention, in terms of Janus's investment, or your ability to select Janus in the Currensee program, Martin and I are actually working through an approach to lower the minimum to be able to have access to Janus's popular A strategy. It's a low-risk strategy, as Martin mentioned, or targeted to have low-risk profile, and you should see some changes by Monday of next week that will enable most investors to be able to have access to all of the trades, which we're very happy to be able to do. Okay, so let's take a few more questions. I have one from Govind. If you say that no trading system is good, Martin, do you recommend using multiple systems?
Yes, absolutely that. That was the intention. So every trading system or every strategy will have its good times and its bad times, okay? And an investor needs to know that. And usually what happens with investors is that they jump to a particular system which has just worked well in the past couple of whatever, days, months, weeks, year, or whatsoever. So they're looking at the history. And at that very moment when Mr. Investor switches that system on or uses that strategy, the market is a little bit different, and all of a sudden the system is producing some losses. And then Mr. Investor thinks, oh, this is a shitty system. It has produced 5 losses in a row. I need to look for a new one. Okay? So this is normal. It is not normal that a system always produces under all market conditions only winners, because a particular strategy works well in certain market conditions which might or might not be present for a pretty long time. Very robust systems always consist of several trading engines doing different things, okay? So that means if I have a breakout system, that usually goes very well with a range trading system, because the problem is that if I have breakout situations which are dying, then I'm doing a lot of stop losses in that breakout system, where in turn the range trading system, or let's say a trend following system, do not work well together. Okay, so you always have to create a portfolio of different systems which work under most but never under all market conditions, because that's impossible. That's what everybody looks for. It's a holy grail, and that doesn't exist in a single system. It might exist in a variety of different systems, but then obviously the investor mentality or the psychology might not serve that well, because you might see more stops than you like to see. Okay, there are a lot of people who think good traders trade without any loss. Then I'm a real bad trader, because I'm having an awful lot of stop losses. Okay, and I'm having also some great trades which are running several hundred pips and then make back what more and more back what has been lost before. Okay, so remember that. So if somebody tells you he's trading without a loss, he has a no loss trading system, just pass.
Well, here's a question about that from Sutton. How do you keep your trade leader profile low risk? How your trade leader portfolio, rather, low risk?
Because we are risking per trade very little. So that means we are not trading even with 2% a trade or something. We are having a risk profile which is deleverage. My second first name is Mr. Deleverage, which means if I have 100,000 in the account, I'm very seldom even trading with 100,000 currency units or one standard lot. Very often we're trading only with 40K or 30K or whatsoever, because we're rather opening multiple positions at different strategies than risking 2% in one particular strategy to figure out, oops, it was wrong, it is the wrong time to trade that, and have 3 or 4 stop outs in a row and then being behind 6%. So what the right strategy approach, in our opinion, is always to deleverage, okay? And if your risk is too high, you see that when you're sitting in front of the screen and you start to feel uncomfortable, because of a lot of people underestimate how fast markets can move and how high the leverage or the true leverage in trade one standard lot, it's only $10 a pip. If you're walking 100 pips, which we had today already 3 times, okay, then we're talking each $1,000. So be careful on that in judging that. So if you're trading a $10,000 account and you're consistently trading with a leverage of 1 to 10 as a trade leverage, then obviously you're risking $1,000 each trade. It could be a very short-lived trading operation. Okay? So 3 stops, you're down 30%. Okay, so that's the problem. So this is what I mean. So instead of risking on a leverage scenario, I strongly suggest, and we do this as well, to start deleverage first, even though your gains might be small, but your losses are also. Okay, and look for the risk-reward ratio, because it's much better to have a 30 pip stop out and a 300 take profit than vice versa.
Okay. Let's get back to the politics. I've got a couple of questions on that. So Pedro asks, do you see the ECB lowering rates to 0 to stimulate growth?
The chance of lowering it to 0. Okay, in fact, the interest rate is at 0. Okay, so using the interest rate politics still with lower interest rates, this instrument is gone. It's long gone. So they can only fuel it either by price, in the sense of what I said before, having or looking for a lower euro, okay, or what they could do is print even more money, which is not really the preferred way of the ECB, actually, because we had already a couple of very negative, so to say, statements from bankers on that particular thing. Even though they do it right now, it's not their preferred way to do that. So I would much rather think than looking at the markets is the appropriate instrument to stimulate the economic growth.
Okay, another similar one from Mark. I hear chatter that the euro could crash. What does that mean, especially for somebody who trades the euro dollar?
Okay, so crash. Crash means, for me, it could go to 0. So the answer is, could a currency go to 0? Oh, most probably not. Okay, so the other scenario could be, or could be meant, that it says, well, the euro could break up, so literally the euro is vanishing from the currency board. So all of a sudden you see no currency crosses in euros. I tried to explain that a little bit from a European standpoint here, that this is foremost a political issue. So it's not so much an economic issue, it's also a political issue, because the euro stands for the union of the European countries, and that is something where everybody on the political side is very proud of, and they have their, let's say, their vision, how they want to move things here along. So I don't think that we can really talk about a crash in the sense of breakup or vanishing of the euro. A crash could be that all of a sudden we figure out that it's totally overvalued and that it is sinking down as fast as it could. But again, there is the political aspect to that, which also would mean that I would expect, at least, that at a certain point people will step up to the plate, either on the investor side or the ECB side, to basically work against that. Nevertheless, I wrote it to one or a couple of people in Currensee where they asked me to look in my crystal ball. I don't have one, but my personal opinion is that we might see a much lower euro during the year of 2012 if we're getting some more surprises on the negative side. But I'm not adjusting the trading to that, so I'm not planning on a euro US dollar of 120 or 110 or whatsoever. I'm planning on where is it now, what do I see on the screen, and what could I do to trade it either up or down to make the trade profitable. And that is the basic thing. So don't be afraid on a horror scenario. Well, we cannot plan for that. On a Six Sigma event, we cannot plan.
Pretty much words to live by. Okay, I am going to wrap the questions here. If you've submitted a question and we haven't gotten to it, we will be emailing you after the webinar. But I want to thank everyone so much, especially Martin from Janus Trading, for being here with us today. Again, if you want to learn more to invest or to allocate, please go to www.currensee.com and or email sales@currensee.com, and we're happy to help. So thanks so much. Thanks, Martin.
Yeah, I thank you. Thanks to the audience for giving me the opportunity to point out some things here. And Shireen, thanks very much. And everybody have a good trading week, good trading year 2012. Thanks.
All right. Goodbye.
Bye.